Reese's Side Quests for another chapter of Imperialism, the Highest Stage of Capitalism by Vladimir Lenin. The first chapter, the last chapter that we read, was largely explaining the history and the logical and theoretical processes that led to the concentration of companies into monopolies. And Lenin's goal in this work is largely to update the communist theory that Karl Marx was developing from the mid to late 1800s into the new era of the 1910s and World War I. And so the last chapter was establishing, how did this actually happen? How did capitalism change so significantly in a short amount of time, in only a few decades, and put numbers to those changes and saying, this is exactly how much more concentrated company ownership has become. This is exactly how much more concentrated the total production of many companies, of many countries, has become into the hands of a few companies. And so this next chapter, chapter 2, is focusing on the banking system and what Lenin refers to as finance capital. He considers this and the emergence of banks as a powerful entity in the general global market as a relatively new phenomenon. And while there were larger scale multinational banks and banking houses essentially earlier than this, such as, we would know the Rothschild banking family and groups like that operated across multiple countries, had ties with many national leaders, and operated across multiple industries as well in their financing. But largely they were financing industries via financing monarchs. And then also a handful of companies in Britain and in, I think also Germany. I'm not 100% sure on that, but he doesn't talk about them. He's talking about a little bit later development where this kind of large-scale banking becomes, common. It goes from this time period in the 1800s where most people, weren't really engaging with banking that much, and banks existed at a largely local or city level, and their influence was limited to that scope. They also would provide financing, loans at a certain rate, and that's just kind of, you save your money in the bank, they provide you an interest rate, they loan your money out at a higher interest rate to some business or entrepreneur that wants to go start their bakery. So he's saying that when banks transition from doing just that into investing on their own decision making into industries like production industries and commercial industries, that largely changed society and will, after this book, he says, presumably continue to drastically change society because these groups are now more firmly situated at the top of the hierarchy under capitalism. And he gives multiple examples in this chapter of how basically these banks both coagulated into more concentrated units, and also how they kind of use that leverage to then increase their power over companies and then eventually over whole industries by saying, if you don't do what we say, if you don't agree with us politically, if you don't conduct your business in XYZ way that we say you should, we're not going to give you a loan, and you don't have anyone else to go to that can give you a loan this big anyway. So that's kind of the direction that he sees everything going, is that bank involvement in industry and in the stock market itself will lead into basically the global elite class becoming entirely composed of financiers and of people who operate in terms of financial trading rather than actual industrial development, and that mentality is a significant shift. So without further ado, let's get into Chapter 2 of Imperialism. Chapter 2. The Banks and Their New Role. The principal and primary function of banks is to serve as an intermediary in the making of payments. In doing so, they transform inactive money capital into active capital, that is, into capital producing a profit. They collect all kinds of money revenues and place them at the disposal of the capitalist class. As banking develops and becomes concentrated in a small number of establishments, the banks become transformed, and instead of being modest intermediaries, they become powerful monopolies, having at their command almost the whole of the money capital of all the capitalists and small businessmen, and also a large part of the means of production, and of the sources of raw materials of the given country and in a number of countries. The transformation of numerous modest intermediaries into a handful of monopolists represents one of the fundamental processes in transformation of capitalism into capitalist imperialism. For this reason, we must first of all deal with the concentration of banking. In 1907 to 08, the combined deposits of the German joint stock banks, each having a capital of more than 1,000,000 marks, amounted to 7 billion marks, while in 1912 to 13 they amounted to 9.8 billion marks. Thus, in 5 years, their deposits increased by 40%. Of the 2.8 billion mark increase, 2.75 billion was divided amongst 57 banks, each having a capital of more than 10 million marks. The distribution of the deposits between big and small banks was as follows. The small banks are being pushed aside by the big banks, of which 9 concentrate in their hands almost half the total deposits. But we have left out of account many important details. For instance, the transformation of numerous small banks practically into branches of big banks, etc. Of this we shall speak later on. At the end of 1913, Schluss-Geiwernitz estimated the deposits in the 9 big Berlin banks at 5.1 billion marks, out of a total of about 10 billion marks. Taking into account not only the deposits but the total resources of these banks, the author wrote, at the end of 1909, the 9 big Berlin banks together with their affiliated banks controlled 11.267 billion marks. That is, about 83% of the total German bank capital. The Deutsche Bank, which together with its affiliated banks controls nearly 3 billion marks, represents, parallel with the Prussian State Railway Administration, the biggest and also the most decentralized accumulation of capital in the Old World. We have emphasized the reference to the affiliated banks because this is one of the most important features of modern capitalist concentration. Large-scale enterprises, especially the banks, not only completely absorb the small ones, but also join them to themselves, subordinate them, bring them into their own group or concern, to use the technical term, by having holdings in their capital, by purchasing or exchanging shares, by controlling them through a system of credits, etc. Professor Leifman has written a voluminous work of about 500 pages describing modern holding and finance companies, unfortunately adding theoretical reflections of a very poor quality to what is frequently partly digested raw material. To what results this holding system leads in regards to concentration is best illustrated in the book written on the big German banks by the banker Reiser. But before examining his data, we will quote an example of the holding system. The Deutsche Bank Group is one of the biggest, if not the biggest, banking group. In order to trace the main threads which connect all the banks in this group, it is necessary to distinguish between holdings of the first, second, and third degree, or what amounts to the same thing, between dependents of the lesser establishments on the Deutsche Bank in the first, second, and third degree. We then obtain the following picture. Included in the 8 banks dependent on the Deutsche Bank in the first degree, occasionally, there are 3 foreign banks, 1 Austrian, 1 Wiener Bankvarian, and 2 Russian, the Siberian Commercial Bank and the Russian Bank for Foreign Trade. Altogether, the Deutsche Bank Group comprises, directly and indirectly, partially and totally, no less than 87 banks, and the capital, its own and others which it controls, is estimated at between 2 and 3 billion marks. It is obvious that a bank which stands at the head of such a group, and which enters into an agreement with a half-dozen other banks, only slightly smaller than itself for the purpose of conducting big and profitable operations like floating state loans, is no longer a mere intermediate, but a combine of a handful of monopolists. The rapidity with which the concentration of banking proceeded in Germany at the end of the 19th and the beginning of the 20th centuries is shown by the following data which we quote in an abbreviated form from Reiser. We see the rapid extension of a close network of canals which cover the whole country, centralizing all capital and all revenues, transforming thousands and thousands of scattered economic enterprises into a single national capitalist, and then into an international capitalist economic unit. The decentralization that Schulze-Gevernitz, as an exponent of modern bourgeois political economy, speaks of in the passage previously quoted, really means the subordination of an increasing number of formerly relatively independent, or rather strictly local, economic units into a single center. In reality, it is centralization, the increase in the role, the importance, and the power of monopolist giants. In the older capitalist countries, this banking network is still more close. In Great Britain, including Ireland, in 1910 there were in all 7,151 branches of banks. 4 big banks had more than 400 branches each, from 447 to 689. 4 had more than 200 branches each, and 11 more than 100 each. In France, 3 big banks, Crédit Lyonnais and the Comptoir National d'Escompte and the Société Générale, extended their operations and their network of branches in the following manner. In order to show the connections of a big modern bank, Reiser gives the following figures of the number of letters dispatched and received by the Disconto Gesellschaft, one of the biggest banks in Germany and in the world, the capital of which amounted to 300 million marks in 1914. In 1875, the big Paris bank, the Crédit Lyonnais, had 28,535 accounts. In 1912, it had 633,539. These simple figures show, perhaps better than long explanations, how the concentration of capital and the growth of their turnover is radically changing the significance of the banks. Scattered capitalists are transformed into a single collective capitalist. When carrying the current accounts of a few capitalists, the banks, as it were, transact a purely technical and exclusively auxiliary operation. When, however, these operations grow to enormous dimensions, we find that a handful of monopolies control all the operations, both commercial and industrial, of the whole of capitalist society. They can, by means of their banking connections, by running current accounts and transacting other financial operations, first ascertain exactly the position of various capitalists, then control them, influence them by restricting or enlarging, facilitating or hindering their credits, and finally, they can entirely determine their fate, determine their income, deprive them of capital, or on the other hand, permit them to increase their capital rapidly and to enormous dimensions. We have just mentioned the 300 million marks capital of the Disconto Gesellschaft in Berlin. The increase of the capital of this bank was one of the incidents in the struggle for hegemony between 2 of the biggest Berlin banks, the Deutsche Bank and the Disconto. In 1870, the Deutsche Bank, a new enterprise, had a capital of only 15 million marks, while that of the Disconto was at 30 million marks. In 1908, the first had a capital of 200 million, while the second had 170 million. In 1914, the Deutsche Bank increased its capital to 250 million, and the Disconto, by merging with a very important bank, the Schaffhauser Bank, increased its capital by 300 million. And of course, while this struggle for hegemony goes on, the 2 banks more and more frequently conclude agreements of an increasingly durable character with each other. This development of banking compels specialists in the study of banking questions, who regard economic questions from a standpoint which does not in the least exceed the bounds of the most moderate and cautious bourgeois reformism, to arrive at the following conclusions. The German review, Die Bank, commenting on the increase of capital of the Disconto Gesellschaft to 300 million marks, writes, "Other banks will follow this same path, and in time, the 300 men who today govern Germany economically will gradually be reduced to 50, 25, or still fewer. It cannot be expected that this new move toward concentration will be confined to banking. The close relations that exist between certain banks naturally involve the bringing together of the manufacturing concerns which they favor. One fine morning we shall wake up in surprise, to see nothing but trusts before our eyes, and to find ourselves faced with the necessity of substituting state monopolies for private monopolies. However, we have nothing to reproach ourselves with, except with us having allowed things to follow their own course, slightly accelerated by the manipulation of stocks. This is an example of the impotence of bourgeois journalism, which differs from bourgeois science only in that the latter is less sincere and strives to obscure essential things, to conceal the wood by trees, to be surprised at the results of concentration, to reproach the government of capitalist Germany or capitalist society, to fear that the introduction of stocks and shares might accelerate concentration in the same way as the German cartel specialist Tschirschky fears the American trusts and prefers the German cartels on the grounds they may not, like the trusts, accelerate technical and economic progress to an excessive degree. Is this not impotence? But facts remain. There are no trusts in Germany. There are only cartels. But Germany is governed by not more than 300 magnates of capital, and the number of these is constantly diminishing. At all events, banks in all capitalist countries, no matter what the law in regards to them may be, greatly intensify and accelerate the process of concentration of capital and the formation of monopolies. The banking system, Marx wrote half a century ago in Capital, presents indeed the form of common bookkeeping and distribution of means of production on a social scale, but only the form. The figures we have quoted on the growth of bank capital, on the increase in the number of branches and offices of the biggest banks, the increase in numbers of their accounts, etc., present a concrete picture of this common bookkeeping, of the whole capitalist class, and not only of the capitalists, for the banks collect, even though temporarily, all kinds of financial revenues of small businessmen, office clerks, and of a small upper stratum of the working class. It is common distribution of means of production that, from the formal point of view, grows out of the development of modern banks, the most important of which, numbering from 3 to 6 in France, and from 6 to 8 in Germany, control billions and billions. In point of fact, however, the distribution of means of production is by no means common, but it is private, i.e., it conforms to the interests of big capital, and primarily of very big monopoly capital, which operates in conditions in which the masses of the population live in want, in which the whole development of agriculture hopelessly lags behind the development of industry, and within it, industry itself, the heavy industries exact tribute from all other branches of industry. The savings banks and post offices are beginning to compete with the banks in the matter of socializing capitalist economy. They are more decentralized, i.e., their influence extends to a greater number of localities, to more remote places, to wider sections of the population. An American commission has collected the following data on the comparative growth of deposits in banks and savings banks. As they pay interest at the rate of 4% and 4.5% on deposits, the saving banks must seek profitable investments for their capital, and they must deal in bills, mortgages, etc. The boundaries between the banks and the savings banks become more and more obliterated. The chambers of commerce at Bochum and Erfurt, for example, demand that savings banks be prohibited from engaging in purely banking business, such as discounting bills. They demand the limitation of the banking operations of the post office. The banking magnates seem to be afraid that state monopoly will steal upon them from an unexpected quarter. It goes without saying, however, that this fear is no more than the expression, as it were, of the rivalry between two department managers in the same office. For, on the one hand, the billions entrusted to the savings banks are in the final analysis actually controlled by these very same bank magnates, while on the other hand, state monopoly in capitalist society is nothing more than a means of increasing and guaranteeing the income of millionaires on the verge of bankruptcy in one branch of industry or another. The change from the old type of capitalism, in which free competition predominated, to the new capitalism, in which monopoly reigns, is expressed, among other things, by a decrease in the importance of the stock exchange. The German review Die Bank wrote, "For a long time now, the stock exchange has ceased to be the indispensable intermediary of circulation that it was formerly when the banks were not yet able to place the bulk of new issues with their clients. Every bank is a stock exchange, and the bigger the bank and the more successful the concentration of banking, the truer does this proverb become. While formerly, in the 70s, the stock exchange fluxed with the exuberance of youth, a subtle allusion to the crash of 1873, and to the company promotion scandals, opened the era of the industrialization of Germany. Nowadays, the banks and industry are able to do it alone. The domination of our big banks over the stock exchange is nothing else than the expression of the completely organized German industrial state. If the domain of the automatically functioning economic laws is thus restricted, and if the domain consciously regulated by the banks is considerably increased, the national economic responsibility of a very small number of guiding heads is infinitely increased. So wrote Professor Schultz-Gewernitz, an apologist of German imperialism, who is regarded as an authority by the imperialists of all countries, who tries to gloss over a detail that the conscious regulation of economic life by the banks consists in the fleecing of the public by a handful of completely organized monopolists. For the task of a bourgeois professor is not to lay bare the mechanism of the financial system, or to divulge all the machinations of the finance monopolies, but, rather, to present them in a favorable light. It is the same way Reiser, a still more authoritative economist, and himself a bankman, makes shift with meaningless phrases in order to explain away undeniable facts. He writes, "The stock exchange is steadily losing the feature which is absolutely essential for national economy as a whole, and for the circulation of securities in particular, that of being an exact measuring rod, and an almost automatic regulator of the economic movements which converge on it. In other words, the old capitalism, the capitalism of free competition, and its indispensable regulator, the stock exchange, are passing away. A new capitalism has come to take its place, which bears obvious features of something transitory, which is a mixture of free competition and monopoly. The question naturally arises, to what is this new transitory capitalism leading? But the bourgeois scholars are afraid to raise this question. 30 years ago, employers, freely competing against one another, performed 9/10 of the work connected with their businesses other than manual labor. At the present time, 9/10 of this business brain work is performed by officials. Banking is in the forefront of this evolution. This admission by Schultz-Gewernitz brings us once again to the question as to what this new capitalism, capitalism in its imperialist stage, is leading to. Among the few banks which remain at the head of all capitalist economy, as a result of the processes of concentration, there is naturally to be observed an increasingly marked tendency towards monopolist agreements, towards a bank trust. In America, there are not 9, but 2 big banks, those of the billionaires Rockefeller and Morgan, which control a capital of 11 billion marks. In Germany, the absorption of the Schaffhauser Bank by the Diskonto Gesellschaft, to which we referred above, was commented on in the following terms by the Frankfurter Zeitung, one of the organs of the stock exchange's interests. The concentration movement of the banks is narrowing the circle of establishments, from which it is possible to obtain large credits, and is consequently increasing the dependence of big industry upon a small number of banking groups. In view of the internal links between industry and finance, the freedom of movement of manufacturing companies in need of bank capital is restricted. For this reason, big industry is watching the growing trustification of the banks with mixed feelings. Indeed, we have repeatedly seen the beginnings of certain agreements between the individual big banking concerns, which aim at limiting competition. Again, the final word in the development of banks is monopoly. The close ties that exist between the banks and industry are the very things that bring out most strikingly the new role of the banks. When a bank discounts a bill for an industrial firm, opens a current account for it, etc., these operations taken separately do not in the least diminish the independence of the industrial firm, and the bank plays no other part than that of a modest intermediary. But when such operations are multiplied and become an established practice, when the bank collects in its own hands enormous amounts of capital, when the running of a current account for the firm in question enables the bank, and this is what happens, to become better informed of the economic position of the client, then the result is that the industrial capitalist becomes more completely dependent on the bank. At the same time, a very close personal union is established between the banks and the biggest industrial and commercial enterprises, the merging of one with another through the acquisition of shares, through the appointment of bank directors to the supervisory boards or boards of directors of industrial and commercial enterprises, and vice versa. The German economist Giedels has compiled very complete data on this form of concentration with capital and enterprises. 6 of the biggest Berlin banks were represented by their directors in 344 industrial companies, and by their board members in 407 other companies. Altogether, they supervised a total of 751 companies. In 289 of these companies, they either had 2 of their representatives on each of their respective supervisory boards, or held the posts of chairman. These industrial and commercial companies are engaged in the most varied branches of industry: insurance, transport, restaurants, theaters, art, industry, etc. On the other hand, there were on the supervisory boards of these 6 banks in 1910, 51 of the biggest manufacturers, among whom were directors of Krupp, of the powerful Hapag, etc. From 1895 to 1910, each of these 6 banks participated in the share and bond issues of several hundred industrial companies, the number ranging from 281 to 419. The personal union between the banks and industry is completed by the personal union between both and the state. Seats on the supervisory board, writes Giedels, are freely offered to persons of title, also to ex-civil servants who are able to do a great deal to facilitate relations with the authorities. Usually on the supervisory board of a big bank, there is a member of parliament or a Berlin city councillor. The building, so to speak, of the great capitalist monopolies is therefore going on full steam ahead, in all natural and supernatural ways. A sort of division of labor amongst some hundreds of kings of finance who reign over modern capitalist society is being systematically developed. Simultaneously with this widening of the sphere of activity of certain big industrialists, sharing in the management of banks, etc., and together with the allocation of provincial bank managers to definite industrial regions, there is a growth of specialization among the managers of the big banks. Generally speaking, this specialization is only conceivable when banking is conducted on a large scale, and particularly when it has widespread connections with industry. This division of labor proceeds along 2 lines. On one hand, the relations with industry as a whole are entrusted to one manager, as his special function. On the other, each manager assumes the supervision of several isolated enterprises, or enterprises with allied interests, or, in the same branch of industry, sitting on their board of directors. Capitalism has reached the stage of organized control of individual enterprises. One specialist in German industry, sometimes even in West German industry alone. The West is the most industrialized part of Germany. Others specialize in relations with foreign states and foreign industry, in information about manufacturers, in stock exchange questions, etc. Besides, each bank manager is often assigned a special industry, or locality, where he has a say as the member of the board of directors. One works mainly on the board of directors of electric companies, another in the chemical, brewing, or sugar beet industry, a third in a few isolated enterprises, but at the same time in non-industrial, i.e. insurance companies. It is certain that, at the extent and diversification of the big banks' operations increase, the division of labor among their directors also spreads, with the object and result of lifting them somewhat out of pure banking, and making them better experts, better judges of the general problems of industry and the special problems of each branch of industry, thus making them more capable of action within the respective bank's industrial sphere of influence. This system is supplemented by the bank's endeavors to have elected to their own board of directors, or to those of their subsidiary banks, men who are experts in industrial affairs, such as manufacturers, former officials, especially those formerly in the railway service or in mining, etc. We find the same system, with only slight difference, in French banking. For example, one of the three biggest French banks, the Crédit Lyonnais, has organized a financial research service which permanently employs over 50 engineers, statisticians, economists, lawyers, etc., at a cost of 600,000 or 700,000 francs annually. The service is in turn divided into 8 sections, of which one deals with industrial establishments, another with general statistics, a third with railway and steamship companies, a fourth with security, a fifth with financial reports, etc. The result is twofold. On the one hand, the merging to an ever greater extent, or as in Bukharin aptly calls it, the coalescence of bank and industrial capital, and on the other hand, a transformation of the banks into institutions of a truly universal character. On this question, we think it necessary to quote the exact terms used by Giedels, who has best studied the subject. An examination of the sum total of industrial relationships reveals the universal character of the financial establishments working on behalf of industry. Unlike other kinds of banks, the contrary to the requirements often laid down in literature, according to which banks ought to specialize in one kind of business or in one branch of industry in order to maintain a firm footing. The big banks are striving to make their industrial connections as varied and far-reaching as possible, according to locality and branch of business, and are striving to do away with the inequalities in the distribution among localities and branches of business, resulting from the historical development of individual banking houses. One tendency is to make the ties with industry general. Another tendency is to make these ties durable and close. In the 6 big banks, both these tendencies are realized, not in full, but to a considerable extent and to an equal degree. Quite often, industrial and commercial circles complain of the terrorism of the banks, and it is not surprising that such complaints are heard, for the big banks command, as will be seen from the following example. On November 19, 1901, one of the big Berlin D banks, such is the name given to the 4 biggest banks, whose name begin with the letter D, wrote to the board of directors from the German Central Northwest Cement Syndicate in the following terms. Quote, "As we learn from the notice you published in the Reichsangier of the 18th instant, we must reckon with the possibility that the next general meeting of your company, fixed for the 30th of this month, may decide on measures which are likely to effect changes in your undertakings which are unacceptable to us. We deeply regret that for those reasons we are obliged henceforth to withdraw the credit which has been hitherto allowed you. But if the said next general meeting does not decide upon measures which are unacceptable to us, and if we receive suitable guarantees on this matter for the future, we shall be quite willing to open negotiations with you on the grant of a new credit." As a matter of fact, this is small capital's old complaint about being oppressed by big capital, but in this case, it was a whole syndicate that fell into the category of small capital. The old struggle between big and small capital is being resumed. On a new and higher stage of development, it stands to reason that undertakings financed by big banks handling billions can accelerate technical progress in a way that cannot possibly be compared with the past. The banks, for example, set up special technical research societies. The only friendly industrial enterprises benefit from their work. To this category belong the Electric Railway Research Association and the Central Bureau of Scientific and Technical Research. The directors of the big banks themselves cannot fail to see that new conditions of national economy are being created, but they are powerless in the face of these phenomena. Anyone who has watched in recent years the changes of incumbents or of directorships and seats on the supervisory board of the big banks cannot fail to notice that power is gradually passing into the hands of men who consider the active intervention of the big banks in the general development of industry to be indispensable and of increasing importance. Between these new men and the old bank directors, disagreements of a business and often of a personal nature are growing on this subject. The question that is in dispute is whether or not the banks, as credit institutions, will suffer from this intervention in industry, whether they are sacrificing tired principles and an assured profit to engage in a field of activity which has nothing in common with their role as intermediaries in providing credit, and which is leading the banks into a field where they are more than ever before exposed to the blind forces of trade fluctuations. This is the opinion of many of the older bank directors, while most of the younger men consider active intervention in industry to be a necessity as great as that which gave rise, simultaneously with big modern industry, to the big banks and modern industrial banking. The two parties to this discussion are agreed only on one point, and that is, that as yet there are neither firm principles nor a concrete aim in the new activities of the big banks. The old capitalism has had its day. The new capitalism represents a transition towards something. It is hopeless, of course, to seek for firm principles and a concrete aim, for the purpose of reconciling monopoly with free competition. The admission of the practical men has quite a different ring from the official praises of the charms of organized capitalism sung by its apologist. Schultz Gewernitz, Leifman, and similar theoreticians. At presently, what period were the new activities of the big banks finally established? Giedels gives us a fairly exact answer to this important question. The ties between the banks and industrial enterprises, with their new content, their new forms, and their new organs, namely the big banks which are organized on both a centralized and a decentralized basis, were scarcely a characteristic economic phenomenon before the 90s. In one sense, indeed, this initial date may be advanced to the year 1897, when the important mergers took place, and when, for the first time, the new form of decentralized organization was introduced to suit the industrial policy of the banks. This starting point could be perhaps placed at an even later date, for it was the crisis of 1900 that enormously accelerated and intensified the process of concentration of industry and banking, consolidated that process, for the first time transformed the connection with industry into the monopoly of the big banks, and made this connection much closer and more active. Thus, the beginning of the 20th century marks the turning point from the old capitalism to the new, from the domination of capital in general to the domination of finance capital. So that is the end of Chapter 2, and the ideas that are being talked about here about finance capital and the big banks is continued in Chapter 3, which is titled Finance Capital and the Financial Oligarchy, which begins to start to tie in the concepts of how this consolidated power in banking and industry starts to directly impact political outcomes in countries. So stay tuned for the next chapter, and you'll start to see how these ideas begin to build into one cohesive thesis. So make sure to like, comment, and subscribe if you enjoyed this, and thanks for watching.